Hi, everyone, and welcome to Income Tax. This is chapter 4 this week. So I just want to just going to make sure that you are seeing the correct screen and we can get the ball rolling. So this chapter talks about additional types of income, and then we're going to look into what we call the qualified business income deduction. Now, this was part of the big tax overhaul in 2018 that allowed for um, a deduction on certain types of income, a 20% deduction on income. So basically, we're going to talk about what a capital asset is. We're going to look at the holding periods to distinguish what a long-term capital gain is versus a short-term capital gain and losses. And we're going to look at disposing of assets, how we compute the tax on capital gains, the treatment of capital losses. We'll talk about the sale of personal residences. We'll look at rental properties and vacation homes. And then we'll take some time to understand how passive income and passive losses are treated. We'll talk about the tax treatment of net operating losses. We'll look at self-employment tax and then the qualified business income deduction. So starting here, we're going to look at what is a capital asset. Well, guys, a capital asset is any property, whether used in a trade or business, other than stocks, inventory, property held primarily for sale to customers in the ordinary course of a trade or business, depreciable property or real property used in a trade or business, a patent, invention, model, design, secret formula or process, copyright, composition, letter, memorandum, other types of property that have been created by a taxpayer, accounts or notes receivable, and U.S. government publications. So any property other than what we just talked about. Okay. Which of these could be a capital asset? Well, shoes held in a shoe store would be inventory. A taxpayer's personal residence would be a capital asset. A painting held by an artist would not be, or nor would accounts receivable be. So, no, we need to talk about what we call the holding period, how long we have had this asset. The holding period for capital assets is how long the taxpayers owned this asset. Long-term assets mean they have been held for more than 1 year. Short-term capital assets are those that are held for 1 year or less. When a capital asset is sold before it is owned for the required holding period, which means over 1 year, then we call it a short-term capital gain or a short-term capital loss. Capital gains and losses receive special tax treatment if they're long-term capital gains. A net short-term capital gain just gets treated like we do wages or interest income. It's just taxed at ordinary tax rates. So the way we calculate the gain or the loss is we look at how much was realized or how much we sold it for, minus what we call the adjusted basis, which could be the cost plus anything we've added to it, would be the gain or the loss. The sale or exchange of an asset results in a capital gain or a capital loss. Generally, a sale requires the receipt of money or the relief of debt in exchange for the property. Basically, a sale has to show some evidence. An exchange is the transfer of ownership of one property for another property. Now, the amount that gets realized from the sale or other disposition of property is equal to money received plus the fair market value of the other property that's received when we're dealing with an exchange, plus whatever costs there are involved in the transaction. If the taxpayer is relieved of a liability, then that amount of the liability gets added to the amount realized. So the amount realized is going to be equal to the cash received plus the fair market value of the property received plus any liabilities that were assumed minus the selling cost of the transaction. The adjusted basis of the property is going to be what you originally purchased it for, plus any capital improvements added, minus any accumulated depreciation taken over the life of the property. Okay? Now, cost included in the basis can be charges for installing utility services, legal fees and recording fees, survey fees, fees to transfer. If you look at the settlement statement, when you purchase the property, they a lot of times have various fees that get added to the basis of the property. Owner's title insurance, any amounts the seller owes that the purchaser has agreed to pay. Costs that aren't included in the basis are those amounts put in escrow, casualty insurance premiums, rent for the property, charges for utilities, charges connected with getting a loan. So basically, know that those legal fees, recording fees, survey fees, state deed taxes, those costs that allow you to secure and purchase that property or sell that property get included in the basis. Now, a basis depends on how the property is acquired. If you receive property as a result of inheritance, then your basis in the property is the fair market value at the time of the decedent's death or 6 months after. If acquired as a gift, the amount of the basis depends on whether the property is sold for a gain or loss by the donee. So on August 4th, Juliana sold 326 shares of stock of nanoplasma that she purchased in June 18th of 2006. So we know that is clearly a long-term capital gain or just because she's had it for over a year. Her cost basis is $10,000. She sold the shares for $19,000 and paid a commission of $1,300. What would be the amount of the gain? So we know she purchased it for $19,000. She had cost of selling it of $1,300. So the amount she's going to realize is $17,700. But the realized gain is going to be that $17,700 minus what she purchased it for back in 2006, because that's her basis in it. So her realized gain that she has to report is the $7,700, would be a long-term capital gain. Let's look at these two scenarios. Ryan received AT&T stock upon the death of his grandfather. The stock cost his grandfather $6,000 40 years ago, and today's worth $97,000 on the date of his grandfather's death. Okay, so in this case, Ryan inherited stock. So when Ryan inherits the stock, Ryan gets to take the fair market value at the grandfather's death. In this case, 97,000 would be Ryan's basis in the stock. Jada, it's a different deal. She received a gift. The stock cost her mother 9,000 5 years ago, and today's worth 6,500 on the date of the death. Excuse me, on the date of the gift. So depending on if it's a gain or loss, depends on which figure we're going to use for Jada. Jada, just because it's a gift, she doesn't get the fair market value. She can get the cost, or in the event of a loss, the lower of cost or fair market value. So, because Jada received the stock as a gift, her cost depends on whether she sells for a gain on or loss. If the stock is sold for $12,000, her gain would be $3,000. But if the stock is sold for $5,000, then she has to take the lower of cost or the fair market value. So in the case of if she sold it for $5,000, she would only get a $1,500 loss. So when it's a gift, it's going to be the lower of cost or fair market value. No, when you're dealing with long-term capital gains, there is a special tax treatment for those long-term capital gains. Short-term capital gains are taxed at ordinary tax rates, but long-term capital gains have a special tax rate. For some taxpayers, it's 0%, others 15 or 20%. There is a type of long-term gain called unrecaptured Section 1250 gains. Those get capped at 25%. And then when we're dealing with gains such as art or gems that you've purchased for someone, coins or stamps from someone, then those get capped at 28%. Now, there's all kinds of capital gains as you're learning. So you got to know which order get included in taxable income. Short-term capital gains are treated as ordinary income. Then we have the unrecaptured 1250 gains. We have gains on collectibles, and then we have our long-term capital gains. We classify the gains, capital gains and losses, as long-term or short-term, and then we net them by the groups they're in. Any long-term capital gains get offset by long-term capital losses. And then short-term capital gains get offset by short-term capital losses. So you end up with a category of the net long-term gains or loss and the net short-term gains or losses. Then we have to determine the net capital gain or loss. The net long-term capital gain or loss is offset by the short-term capital gains or losses. Now, if the net long-term capital gain exceeds the net short-term capital loss, then we've got long-term capital gains. Or if our net long-term capital loss exceeds our net, if our short-term capital losses exceeds our net long-term capital gains, then we've got a short-term capital loss that we're going to take and carry forward. Or you could have a net long-term capital loss that exceeds the net short-term capital gains. You would then have a short-term capital gain, or the net short-term capital gain exceeds any net long-term capital losses, again, that's going to be just ordinary income. Chevril has the following capital gains and losses in the current year. She's got a $2,000 capital loss, a $12,000 capital gain from this year, and then she carried over from the year before a $7,000 long-term capital loss. So, what would we see her position to be? Well, in long-term capital gains offset with long-term capital losses, that's a $5,000 long-term capital gain. And then when we offset it with the $2,000 short-term capital loss, that ends up being a $3,000 long-term capital gain. It's telling us what are the tax implications if he has adjusted gross income of $42,445 and he's had a household. So basically, we know we take the net of the long and short-term gains and losses, and they're at 5. Then we offset that with the short-term capital loss of 2 to get an overall capital loss position, long-term, of 3,000. If you look at the charts, it's going to be taxed at 0% because the AGI is 42,445 and he's had a household. No, and guys, you're going to have charts to know where to look for this information. Know that the net capital losses may be deducted against ordinary income in amounts up to 3,000 per year, and you can carry it over indefinitely till you use it up. When you have a carryover loss, you have to keep track if it's a long-term or a short-term carryover loss. So you might have 10,000 of long-term carryover losses and 5,000 of short-term carryover losses, but we keep them separate. No, if a taxpayer has both net long-term losses and net short-term losses, the net short-term losses get deducted first. When a taxpayer ends up with net capital losses, the losses offset capital gains using the ordering rules. Net short-term capital losses first reduce the 28% gains. Then they reduce the 25% gains. Then they reduce the long-term capital gains. The net long-term capital losses first reduce the 28% gains, then the 25% gains, then any short-term capital gains. Losses from the sale of personal capital assets are not allowed. It's a personal loss. You cannot take it. Special rules for company stock. There's a certain stock called Section 1202 stock. And a certain percentage of gain in this stock can be excluded from income. Losses on this Section 1244 stock are allowed to be treated as ordinary losses. So I don't run into that very often, but it's there. Know that all capital gains and losses get reported on Form 8949, and then ultimately the net gets transferred over to the Form Schedule D. So Priya has a $15,000 capital loss this year. She's thinking about selling some investments that have a large gain prior to the end of the year in order to offset $12,000 of that loss. Should she sell or not? Well, it really is a matter of personal opinion. If it's a long-term selling some investments that have a large gain prior to the end of the year. Uh, Um, it's really hard to know if she is this a long-term capital gain, a short-term capital gain. Um, I think it's truly um, everyone's opinion as to um, if she should sell that or not. But definitely, if she's got a big gain happening, why not sell it to offset the loss? And then you still have that 3,000 carryover. So, personal residences, you don't get to write off a loss on a personal residence. It used to be that after 97, you could exclude a certain amount of income for gains on the sale of a residence. And oftentimes you had to purchase another residence. Then, for at least what you sold your residence for. Then in 2009, they limited the exclusion. So basically, know that now, after 2009, the residence gain exclusion is limited to an exclusion of 250,000 if you're single or 500,000 if you're married. And there's certain you've got to own it and you have to have lived in it for the past 2 out of 5 years. Prior to that, the key was you had to at least purchase another residence of equal value to defer the gain. Um, So Zach, a single taxpayer, purchased a house 20 years ago for 30,000. Zach married Rosa 3 years ago, and she's lived in the house since their marriage. If they sell the house in December of 2024 for 350,000, what is their taxable gain on a joint return? So in this case, they are married and they should be allowed a $500,000 exclusion for this property. If Zach was just single, um, the gain would be limited to 250,000 that would be excluded. But they are married and they've lived in the home for the past 2 out of 5 years, so there would be zero taxable gain. Now let's explore rental income and expenses. Rental income is reported on Schedule E. Vacation homes uh, are limited. A vacation home is a home where the taxpayer may or uses it and then may rent it out for a portion of time. The deduction of expenses associated with a vacation home gets limited based on the period the residence is used for personal versus rental purposes. So, if it's a primarily personal use, it's all treated as personal residence if it's rented fewer than 15 days per year. You don't have to do anything with it. Everything gets written off as itemized deductions. If it's primarily rental use, if you've rented it for at least 15 days and if what you would do is allocate the amount of personal use versus the rental use and allocate the cost accordingly. You can deduct a loss against other income if there is passive income associated with this or based on your income situation. If allocable rental expenses get deducted in a certain order. So when you've got rental use and then personal use, know that you have to first write off on the rental portion the interest and taxes allocable. Then you take the allocable utilities and maintenance. But you need to have positive income in order to deduct those rental expenses. So the M. Bale family owns a ski condo in Utah, and in the current year, personal use is 25 days and rental use is 50 days. So we see the rental income and we see all the various expenses. What of this is handled on the Schedule A, which are itemized deductions, and then the Schedule E? So first we have to decide what category is this in? Well, since the condo is being rented for 15 days or more, and the M. Bale family uses it for personal use for more than 14 days or 10%, then we have to allocate it based on vacation home limitations. So with the gross income being 10,000, we first take the rental portion of mortgage interest and taxes. So we would take the 50 days of rental use divided by 75 total days and come up with the amount of interest and taxes that are handled against the Schedule E. Then from that, we then take the other miscellaneous expenses to come up with that allocation of 2/3, 66.6% of the other expenses get allocated to the Schedule E. And then we take the depreciation just to go to zero. You cannot take a loss when it's rental property or vacation property where you've used it for more than 14 days. The interest and taxes allocable to the family's personal use is going to be 33%. And then the rental portion of interest and taxes and other expenses gets allocated at 66.7%. The depreciation you can't take because you can only go to zero on vacation rentals of this nature. That portion that you couldn't take in depreciation gets carried forward to next year. Security deposits to be returned at the end of the lease shouldn't be included in gross income and wouldn't be deducted as an expense. Collections of rent in advance are treated as rental income since we're cash basis taxpayers. So when you receive the rent is when you're going to treat it as income. Expenses paid by the tenant on behalf of the rental property owner are generally included in rental income. So if Garrett owns a lake home and he rented the home for $1,800 for 2 weeks, lived in the home for 3 months, and left the home vacant during the remainder of the year, and we've got expenses of $5,000 in mortgage interest, $700 in property taxes, $2,100 in utilities and maintenance, and $3,000 in depreciation. How do we handle this? So basically, since the home was rented for less than 15 days, it's really personal use. Garrett, in this case, wouldn't even have to report the income of $1,800 because it's under 15 days. So basically, on his Schedule A, he can write off the mortgage interest and property taxes, but all the other expenses are not deductible. So we're going to talk about it can be tricky what we call passive losses. No, there's all kinds of income, but primarily we have active income, wages, self-employment income, salaries. We call that earned income, income we earn by doing something. Portfolio income, interest and dividends, we make that income um, based on having assets that make money. There's also income we call passive, rental income, or income that gets passed through limited partnerships or other business ventures, where really you've invested money and you receive income or losses, but you're not really doing any work. You're not actively participating in those companies. We call that passive income or passive losses. Because there's no involvement in an activity or very limited, we call that passive. And we can't deduct passive losses unless we have passive income to offset it with. So basically, if all we have are passive losses, we can't deduct those. We carry those forward to a year where we can finally deduct them or when we finally sell or dispose of the investment. Passive losses generally cannot be used to offset active or portfolio income. Any unused passive losses can be carried forward and deducted in future years. As I said here, losses remaining when taxpayers dispose of the entire interest in the passive activity then gets used in full. So you don't use it, or excuse me, you don't lose it. You will eventually get to take that. Rental property can be tricky. Generally speaking, rental property is treated as passive activities. Even though the taxpayer manages the property, it's still treated as passive because there's not a lot of involvement. Based on a taxpayer's income, taxpayers can deduct up to $25,000 of rental losses against other income if they actively manage the property. Now, once a single taxpayer's modified adjusted gross income goes over 50,000, it starts getting limited. And then once that income goes over 150,000, you cannot even take the $25,000. Okay? Real estate rental would, when it's really a trade or business, so there are people that it's not passive. For example, I have a client, he has about 30 rental properties. That is a business for this man. That is his full-time job, handling 30 rental properties. Taxpayers heavily involved in real estate rentals may qualify as having an active business. For it to be considered an active business, more than 50% of the individual's personal service during the tax year is performed in property, trade, or business, and more than 750 hours of service is performed by the individual during the tax year. So clearly, it's not going to be an active business if you have one or two rental properties. But in this case, with an individual that has 30, and then you also have to look at does he have another job? What kind of time is spent on that other job? Because more than 50% of the individual's personal service during the tax year is performed in that rental property. If both of these conditions are met, then the taxpayer can take the entire loss because he's actively acting as a real estate professional. Daphne's single and owns and actively manages a rental duplex that shows a loss of $20,000. Her modified adjusted gross before the loss is $118,000. What amount of the rental loss can be claimed? How much could be claimed if her loss is 2,800. So again, once it's over 100,000, it gets limited. So the um, her modified adjusted gross before the loss is 118. So that 118 or 18,000 is over the 100,000. Therefore, she has to take that 25,000 and only take 50% of her $18,000 loss. Excuse me. I'm saying it wrong there. She had a loss of 20,000. So she has to take the amount that went over 100,000 or the 18,000 and only take 50% of that or 9,000. So she has to take the 25,000 max loss you can have minus that 9,000, and she's allowed a $16,000 loss. So I'm sorry, I just want to repeat that again. Since her income before the loss is 118, she has to take what her modified adjusted gross is, subtract that from the 100,000, and she's at 18,000. Half of that 18,000 is 9. So that maximum loss of 25,000, she has to subtract 9,000 from it because she's over the 100,000 adjusted gross income. So the 25 minus the 9 means the maximum she's able to take is 16,000. If Daphne's loss was only 2,800, she'd get the full amount. But she can only take up to a $16,000 loss based on her income. It gets confusing, guys, these rental properties. I'm going through this in a nutshell, but it's involved. So again, you're not going to have to memorize these things. You just need to understand them. Net operating losses. These are the net operating loss provision is used to help provide relief for those taxpayers that have losses from trades or business and casualty or thefts. All items of income deductions, gains, and losses have to be categorized if they're business related or non-business related. Rules for net operating losses are categorized with those that happened before 2018, those that happened between 18 and 20, and those that happened after 2020. So know that going forward, we have to carry those pretty much forward. The net operating losses now have to be carried forward. The tax law places an annual limitation on non-corporate business losses. After adjusting for inflation, the 24 limits are 610,000 for being married and 305,000 for all others. The business loss limitation is in place through 2028. I don't have many clients that fall into that category. So guys, Manfred and Mary are your clients. Their 2 children live at home. Molly's a senior. Matthew commutes to a local college. Manfred owns and operates a landscaping business. He has 6 employees, 3 pickup trucks that are used for transportation to job sites. The business had a credit card for use by the employees and Manfred, who fills the trucks with gas almost daily. Manfred gave a business credit card to Mary, Matthew, and Molly and told them to use it to buy gas for their automobiles. In the current year, his wife and children put $5,200 of gas in their automobiles using the business credit card. He wants to deduct that $5,200 on his Schedule C. He feels a small amount. This is small compared to the business gas purchases his employees use of $28,000. Manfred says the amount charged are spread throughout the credit card statements and would be difficult for the IRS to detect in an audit. Would you sign the paid preparer's declaration on this return? Technically, you shouldn't because you are aware of something he's doing wrong. So in case he is willing to retract that, then, and you are aware that he's adding this expense to your return, you could have trouble. You could be put into penalties because you're aware of the false expense here being reported. Self-employment tax. Now, we've talked about self-employment tax in the previous chapter. FICA talks about or imposes two taxes, the Social Security one and the Medicare. Self-employed individuals are required to pay the entire FICA tax, the employee and the employer portion of 12.4% up to 168,600. Each year it increases. The Medicare tax of 2.9% applies to all earnings. For self-employed individuals who also receive wages that are subject to FICA taxes, the maximum base amount for self-employment taxes gets reduced by those amount of wages. So basically, if an employee has a W-2 for 80,000 and then they have self-employment earnings of 100, combined, you still don't have to pay Social Security over the 168,600, but you pay Medicare tax on all of it. Again, we learned from chapter 3 that self-employment taxes, you pay self-employment tax once your net self-employment income is 400,000 or more. Net earnings from self-employment include gross income from a trade or business minus those deductions, a distributive share of partnership income from a trade or business, and net income earned as an independent contractor. And we talked about in chapter 3, half of the amount you pay in self-employment tax, you're allowed to deduct as an adjustment for gross income, adjusted gross income. Zaria is self-employed. From her practice, Zaria earns 108,000 and she has wages of 72,000 from a part-time job. Zaria's total self-employment tax is going to be the 108,000 times 92.35% or 99,738, because you're able to deduct that portion for self-employment tax. Compute self-employment tax for Social Security and Medicare. So if she received a W-2 of 7,200, then she has a base of 161,400 that is still left. But based on her 99,738 times the 12.4%, she'll pay the 12,368 for Social Security, and it's unlimited for Medicare tax. Last, we're going to talk about a qualified business income deduction. Now, this is supposed to expire soon, but hopefully it will be reinstated. The net amount of qualified items of income, gain, deduction, and loss relating to any qualified trade or business in the United States gets applied. It excludes short-term capital gains or losses. It excludes long-term capital gains or losses, nothing with dividend income or interest, nothing with any commodity transactions or foreign currency gains or losses, and it doesn't include anything relating to notional principal contracts, and it's not linked with anything related to an annuity. Basically, the tax law allows a safe harbor under which income from rental real estate can qualify for this qualified business income deduction. The requirements are 250 hours or more spent by the taxpayer with respect to the rental activity. Contemporary, contemporaneous records have to be maintained in separate books. So the QBI cannot exceed 20% of the taxpayer's taxable income. For taxpayers with taxable income above certain thresholds, the allocable share of W-2 wages then gets limited. So it can be involved, thank God for software. The qualified business income from a service-related trade or business may be subject to limitations if income is in excess of the threshold. These get reported on Forms 8995 and 8995A. So 8995 is used for taxpayers whose taxable income before this qualified business income deduction doesn't exceed the phase out thresholds. And then those where it does would have to use that alternative form. You recently received the following email. I won a big at a casino. I took the 3,000 I won and bought 100 shares of stock. The stock's done well. I'm thinking of selling before the end of the year. The price has reached 240 per share. Is there any reason I should wait and sell later? If I don't sell, the price might go down. Any suggestions on what I should do? Well, basically, if the stock has increased that greatly, the capital gain rate based on this income level would be zero anyway. So why not sell it? It's not going to harm her at all. Now, no, capital gain rates, we're I'm speaking from Minnesota as I'm giving this lecture. Minnesota does not have tax preferences on long-term capital gains. We're dealing with the IRS. All states handle things differently. But for this purposes for the IRS, that would be taxed at 0%. So that might be a great call. Again, it's all relative as to all the specifics of that person's situation. So I hope that's been helpful, guys. Have a great night.